Warren Buffett has 53. Elon Musk famously has none outside of the companies he owns. This global index has 3,900, and the S&P 500 has, yep, you guessed it. No, you didn't. 504. I want to tell you a story, and it's a true story as well. Two writers are standing on a beach. They're there for a party, and this beach is on Shelter Island, which, for those who don't know, is one of the most exclusive places to live in America. I mean, look at the state of this house. Quaint. So it will come as no surprise that the party is hosted by a billionaire hedge fund manager, a master at the art of picking stocks. One writer turns to the other and says, "Do you know, Joseph, the guy hosting this party made more money in one day than you did from your book." The book in question is Catch-22. It sold more than 10 million copies and is considered a modern classic. True story, like I said. Joseph takes a sip of his drink and goes, "Yeah, but I have something he will never have, Kurt." "What's that, Joe?" "Enough." Enough. A word of Germanic origin that means sufficient, satisfied, done. So how many stocks or investments is enough? How many should we own? Is there such a thing as too many? Those are the questions we will answer today, and by the end of this video, I hope you will be satisfied with the answer to a question that has been debated for decades. Hi, I'm Tom Morgan, financial advisor and the owner of the YouTube channel That Finance Show, and for some reason the good people at Trading 212 still haven't had enough of me, so I'm back again to discuss how many stocks should you own. Remember, nothing in this video is financial advice. Okay, question for you. How many people do you need to get into a room to have a 50-50 chance of two people having the same birthday? 365 days in a year, we don't count those Benjamin Button wannabes born on a leap year. But yeah, how many? It may surprise you to learn the answer is only 23 people. If you get 75 people in a room, there's a 99.9% chance that two of them have the same birthday. This is called the birthday paradox, and it demonstrates that we don't actually need that many of something to cover the bases, to diversify our chances of getting the outcome we want. Diversification can be defined as spreading your bets, and the common wisdom is with investing, the more you spread your bets, the better, which is half of the reason index funds have become so popular, the massive amount of diversification. But academic studies say this is too much. In 1970, Lawrence Fisher and James H. Lorry released some studies of variability of returns on investments in common stocks. This study made some pretty interesting discoveries, namely that if you took all the companies listed on the New York Stock Exchange and picked 30 at random, you would get around 95% of the diversification benefit of just owning the whole lot. From this, the 30 positions rule was born, and many stock pickers refined this by saying, instead of picking 30 random stocks, I'll pick 30 I think are great, getting the diversification benefit but with great companies that I think will do well. So why does Warren Buffett own 53 stocks then? Anyway, the problem with this 30 rule is the study has been widely disproven in recent times. So this conversation all comes down to what is diversification? The Fisher and Lorry study focused on risk and the reduction of risk in a portfolio, but only in one market, America. So that portfolio was only made up of large American businesses. But really, to be properly diversified, we need exposure to all types of businesses, in all types of sectors. All of these, and all of these. This starts to become a bit overwhelming, doesn't it? I don't know about you, but my knowledge on emerging market consumer discretionary small cap companies is a little rusty. I'll tell you what, let's ask the big man what he thinks about how many companies you should own.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing.
What, Warren?
Diversification is a protection against ignorance.
Who's he calling ignorant? Okay, before we start trolling Warren, let's think about what he is saying there. We buy lots of stocks and diversify to spread our risk, to stop us going all in on a bad idea. But let me ask you a question. If you knew which way an investment would go, would you still diversify into other investments? If you were 100% certain of the way the price would move, would you still spread your cash around? Of course you wouldn't. You would stick everything you had in it. The downside to diversification is by spreading your money thin. When you're invested in a winner, you don't have everything on that company. It's like you're in a casino betting on the Reds. A number comes up that is red, you win. But if you'd bet on that number on its own, you would have won a whole lot more. This is known as the opportunity cost of diversification. Now, what Warren is saying here, while he breaks our hearts calling us ignorant, is if you are a skilled investor, knowing what you're doing when it comes to valuing a business, you will follow that up with conviction and put as much money into that business as you can. It's better to go all in on your best idea than spread your money over your 5th, 6th, 7th, 8th best ideas. So why does Warren have 53 stocks then? Because even he acknowledges how hard it is to pick a sure thing and then go all in on it. Between 1983 and 2006, the 3,000 largest companies in America that make up the Russell 3000 index performed as follows. 18.5% lost at least 75% of their value, 39% of the companies were unprofitable, and 25% of the companies made up all of the returns. Jack Bogle, the founder of Vanguard and arguably the poster child of spreading it far and wide when it comes to how many stocks you should own, famously said, "Why look for a needle in a haystack when you can just buy the haystack?" And credit to Jack, buying the haystack has been very profitable for those who did. Let's say in 1983 you started investing £300 a month into the Russell 3000 and you did that every month until today. You bought all of those businesses, including the ones who lost 75% of their value. If you stay consistent, you would have £1.6 million today. Who's ignorant now, Warren? Don't see this question as a catch-22. There is no right answer. It's about yourself and your own conviction in your decision-making ability. You need to be honest with yourself. How sure are you that you know what you're doing? Do you have more conviction in your investing decisions than Warren Buffett? Are you actually valuing businesses or just buying them on a hunch? When it comes to this question of how many companies should I own, how diversified should I be, the answer is, how much conviction do you have in your ability to pick businesses that will outperform the market? If the answer is none, then diversification across a broad spread of businesses is likely the way to go. If the answer is none, but I still want to give it a go, well, then allocate your capital according to that conviction. Don't go all in on a hunch. But let's say you are full of conviction, please. Just heed the warnings of the wider world right now and see how those who 12 months ago were sure crypto, as an example, was the future and now sit here with all of their funds gone because of factors outside of their control. Sometimes it isn't enough that you found a good business. Things can go ways you could have never foreseen. Fraud, a change of leadership, or the founder decides to buy Twitter and carry a sink through the front door. Even Warren Buffett, arguably the greatest investor of modern times, does not have enough conviction in the businesses he buys to go all in on one. Just remember, stocks represent businesses, and businesses are inherently complicated. No one can tell you how many you should own. That is up to you. The most quoted study says 30, the follow-up says 60. Warren Buffett has 53, and I personally use funds to buy hundreds and hundreds of them, as I'm more than comfortable with my lack of conviction and accepting that I can't predict the future. All the options are here, look on the Trading 212 app, whatever way you choose to invest. If you're already using and enjoying the app, could you do me a huge favour? Please consider leaving up to a 5-star review on the App Store or Google Play to let others know how good it is. Oh, and subscribe now to the Trading 212 channel with notifications turned on so you don't miss any future videos. I've been Tom from That Finance Show. Thanks for watching. I'll see you on the next one.